Industrial real estate has held up remarkably well throughout 2020 and the pandemic. However, there are both winners and losers in this asset type. Clearly, companies and users of industrial real estate, especially bricks and mortar retail fulfillment, restaurant service companies, and some of the newer types of users like activity centers and kid play gyms have not fared so well during the lockdowns and will continue to face hardships as new lockdowns are announced. However, it is undeniable that e-commerce fulfillment, as well as last mile fulfillment, and even manufacturing have taken up additional space, driving activity in the industrial market. But with consumer confidence remaining exceptionally low and overall retail sales still suffering, how much industrial space will they actually need going forward? Furthermore, despite the great news about automotive spending, is manufacturing really coming back? Welcome to the Colliers perspective on the Canadian industrial market. My name is Roelof van Dijk, Colliers Senior Director of National Research and Analytics for Canada, and I hope to share with you our insights on how the Canadian industrial market is performing, and more importantly, provide an outlook for 2021 and beyond. Before we can discuss the industrial outlook, we need to first look at the economic outlook, specifically the expected rebound in employment. Well, at the depths of the pandemic lockdown in April, Canada saw over 3 million jobs vanish. The good news is that approximately 80% of these jobs have essentially been recreated as of November 2020, and the Conference Board of Canada is forecasting that the remaining 20% will be recreated or new jobs created, bringing us back to a net positive job growth scenario by year-end 2021 or early 2022. However, as many jurisdictions across the country continue to struggle with a resurgence of COVID-19, expect this relatively rosy job outlook to slow and the return of the remaining lost jobs to take a little longer than anticipated. More relevant to the industrial sector is employment in the manufacturing, transportation and warehousing, and construction sectors, as these are heavy industrial real estate using sectors. The manufacturing sector is actually the only one of these that has seen positive employment growth in 2020 year to date, up 1% as of November 2020. The construction and transportation and warehousing sectors are down 7% and 7.8% respectively. The performance of the transportation and warehousing sector may come as an initial surprise. However, we can't forget all the hardships being experienced in the bricks and mortar retail, as well as restaurants and the companies that supply them. Furthermore, the e-commerce companies definitely do more with less people, preferring to implement automation and mechanization for efficiency. This also helps them when it comes to labor disruptions as it relates to COVID-19 outbreaks. So, expect more companies to invest in this going forward. In regards to increased manufacturing, part of the issue has been increased local production of goods in order to get around geopolitical issues and supply chain issues. And although Joe Biden as the US President-elect likely means we will not be subject to further major trade disputes with the US, the Buy American policies and softwood disputes, among others, are still in play, and Biden does not see them going away. Furthermore, despite many American companies looking to onshore or even reshore production closer to home, they will likely not choose Canada to do this simply because of our higher cost of labor when compared to their other major trading partner to the south. Although we welcome the announcements regarding automotive manufacturing investments by GM and Ford in Ontario, these will likely not be the norm. So how have industrial markets across Canada performed in light of the pandemic? Well, despite an initial jump in vacancy as the pandemic shutdown took effect, vacancy rates across the country have remained relatively flat, with national vacancy up only 10 basis points year over year to 2.7% in Q3 2020. Furthermore, rent continues to increase, up 66 cents per square foot year over year to $10.16 per square foot in Q3 2020. With overall national vacancy expected to increase to 3.4% by year-end 2021, rents will likely flatten before resuming growth in 2022. This outlook is clearly a lot rosier than any outlook for retail, which is interesting given that a lot of the industrial space is considered de facto retail space as a result of e-commerce. The fate of e-commerce, industrial real estate, and retail real estate are so intertwined, it is worth looking into this relationship further. Notwithstanding grocery retail and necessities, retail sales in general have taken a beating this year. This only furthers the pain in the retail sector that has been occurring since the Bank of Canada started increasing interest rates way back in 2017. In fact, retail sales growth per capita has been negative since Q2 2018, meaning the only reason retail sales was actually growing prior to the pandemic was due to population growth and immigration. Now, with consumer confidence at record lows as of mid-2020, and only now rebounding to depths last seen during the financial crisis, things are not looking great. Many Canadians remain unemployed or underemployed, meaning discretionary spending is on pause until further notice. E-commerce has seemingly benefited from the lockdowns as consumers who were unable to partake in physical retail therapy, they took to the web and to the Amazons of the world. As a result, at the depths of the spring lockdown, e-commerce represented a record 10.3% of total retail sales. Granted, this was on a lower total retail sales figure. However, the actual dollar spend online reached almost $4 billion in May, an all-time record, shattering the previous record of $2.7 billion in December of 2019 by $1.3 billion or 50%. The assumption for e-commerce is that once people start using it, they realize the convenience and continue using it. Therefore, this is expected to be a pivotal moment for e-commerce, hence the gearing up for a dramatic increase in fulfillment on the industrial side of things. There's potentially some caution on this front, as the data also shows that as the lockdown lifted in the summer, e-commerce sales quickly fell off. Despite this, e-commerce in August still represented over 5% of total retail sales at $2.8 billion. Bettering the December 2019 performance. Furthermore, as the country re-enters modified lockdowns in different cities, which may impact the holiday season as well, expect e-commerce to take a significant bite out of November and December 2020 retail sales. Ultimately, the outlook for industrial commercial real estate is relatively positive, especially compared to retail or even office. Demand is expected to remain in place from the sources discussed above, but also interesting sources such as self-storage and data centers. This will drive down vacancy and drive up rents by late 2022, with the only major issue for industrial being the ability of developers to deliver enough new supply and fast enough to allow tenants to continue growing without overheating in some markets. This should bode well for values and also investment in this product as demand remains high. Again, my name is Roelof van Dijk, Colliers Senior Director of Research and Analytics for Canada, and thank you for watching the Colliers Perspective on the Canadian industrial market. For more information and reports about markets that might be of interest to you, please visit our website at www.collierscanada.com. Thank you again.